The Clarity Act missed its deadline. March 1st came and went. No deal on stablecoin rewards. Headlines say the crypto bill is stuck. Politicians argue. Banks push back. Crypto companies scramble. But here's what almost nobody is explaining. This isn't a delay. It's a negotiation over who gets to control the rules of digital money. And the single issue blocking everything, whether stablecoins can pay rewards, determines who wins the next decade of finance. Because the question sounds technical. Can Circle or Tether or any stablecoin issuer pay you interest for holding their tokens? But that technical question is actually a power question. If crypto companies can pay yield on stablecoins, they compete directly with bank deposits. If they can't, banks keep their monopoly on interest-bearing dollars. So, when you hear deadline missed, what you're actually watching is a fight over who gets to be the bank of the future. And understanding that fight matters more than any prediction about when the bill passes. Because the outcome shapes everything that comes after. If you want to understand how financial systems actually get built, not just how they get marketed, subscribe. Because what comes next breaks down the incentives, the power dynamics, and why this single issue can determine whether crypto integrates into finance or finance absorbs crypto. Let's get into it. Let's start with what actually happened on March 1st. The White House set that date as a target for resolving key stablecoin issues, specifically the rewards question. Banks and crypto companies were supposed to negotiate, find compromise, move forward. March 1st arrives. No agreement. Does that mean the bill failed? No. It means the negotiation continues. Here's why that distinction matters. Legislative processes don't work on hard deadlines unless there's a forcing mechanism like government funding expiring or a debt ceiling. The Clarity Act has momentum, but no existential deadline. March 1st was a White House coordination target, not a statutory requirement. Missing it doesn't kill the bill. It just means the fight isn't resolved yet. So what happens now? The Senate committee prepares for markup, which is the stage where amendments get proposed and negotiated before a full Senate vote. That markup is expected mid to late March. Between now and then, the parties involved, banks, crypto firms, Treasury, Senate staff, try to find language everyone can live with. But let's be clear about what everyone can live with actually means. It doesn't mean everyone's happy. It means both sides accept an outcome they don't love, because the alternative, no bill at all, is worse for everyone. That's how compromise works in practice. Nobody wins completely, but the system moves forward. Now, why does this matter for understanding what's actually happening? Because if you're waiting for a clean victory where crypto companies get everything they want or banks get everything they want, you're waiting for something that won't happen. What you'll get is a negotiated settlement where both sides give up something to get something else, and understanding what each side is willing to give up tells you where the real power lies. So let's dig into the core dispute: stablecoin rewards. What does that even mean? A stablecoin is a digital token pegged to $1. You hold one stablecoin, it's worth $1. The stablecoin issuer, Circle, Tether, whoever, holds reserves backing that token, usually cash or short-term treasuries. Now here's where it gets interesting. Those reserves earn interest. If the issuer holds $1 billion in treasuries yielding 4%, they're making $40 million a year. The question is, do they keep all that interest, or do they share it with the people holding the stablecoins? Crypto companies want to share it. They want to pay rewards to stablecoin holders. Not necessarily all the interest, but enough to make holding stablecoins attractive. Why? Because if you can hold a dollar-pegged token that also earns you 3% yield, why would you keep dollars in a checking account earning 0? Banks oppose this loudly, because if stablecoins pay yield and bank deposits don't, money flows out of banks into stablecoins. That's a direct threat to the deposit base that funds the entire banking system. So the bank's position is simple: no passive yield on stablecoins. If you're just holding them, you don't earn anything. The crypto company's response is to propose workarounds. What if we don't call it yield? What if we call it staking rewards? What if it's a membership program with benefits? What if it's tied to some activity, not just holding? And the bank's response to those workarounds? Still no, because they see through the framing. If it looks like yield, acts like yield, and attracts deposits like yield, it's functionally yield. Calling it something else doesn't change the competitive threat. Now let's talk about why this matters beyond just banks versus crypto companies. Because this fight is actually about the structure of the financial system. Let me explain. Right now, when you deposit money in a bank, the bank pays you interest maybe, if they feel like it, if rates are high enough. That interest comes from the bank lending your deposits out and earning more on loans than they pay you. The gap between what they pay depositors and what they earn on loans is how banks make money. But banks are also regulated. They have to hold capital reserves. They have to follow lending rules. They have deposit insurance through the FDIC. All of that regulation exists because banks create systemic risk. When banks fail, the damage spreads. So society accepts the trade-off. Banks get certain privileges, like FDIC insurance and access to Federal Reserve facilities. In exchange, they accept heavy regulation. Now, stablecoin issuers want to pay yield, but don't want to be regulated as banks. They want the upside, attracting deposits with competitive rates, without the downside, capital requirements, and systemic oversight. From the bank's perspective, that's not fair competition. That's regulatory arbitrage. And from a systemic stability perspective, it's a real question. If trillions of dollars flow out of regulated banks into less regulated stablecoin issuers, what happens during a crisis? Stablecoins backed by treasuries should be safe, but what if there's a run? What if everyone tries to redeem at once? There's no FDIC backstop. There's no lender of last resort. So the banks aren't just protecting their business model. They're also raising genuine concerns about financial stability. Now, whether those concerns are the real motivation or just convenient arguments is debatable. Probably both. But the concerns aren't baseless. The crypto industry's counter-argument is that stablecoins are actually safer than bank deposits because they're fully reserved. Banks operate on fractional reserves. They only hold a fraction of deposits as cash. Stablecoins, at least the major ones, hold one-to-one reserves. Every stablecoin is backed by $1 of assets, so in theory, a stablecoin shouldn't have a run problem. If everyone redeems, the issuer has the assets to pay everyone back. But that assumes the assets are actually there, properly audited and liquid, and those assumptions have been tested before. Tether has faced questions about reserves. Others have faced temporary depegs, so the fully reserved on perfectly safe argument isn't bulletproof either. Let's talk about the federal coordination angle, because this is where the Clarity Act becomes structurally important beyond just the rewards question. Right now, crypto regulation in the US is fragmented. The SEC claims some tokens are securities. The CFTC says some are commodities. Individual states have money transmitter laws that vary wildly. The result is a mess. Companies don't know which rules apply. Compliance is expensive and inconsistent. The Clarity Act aims to create a unified federal framework. It would clarify which agency has jurisdiction over what. It would set standards for stablecoins, issuance, reserves, redemption. It would preempt state money transmitter laws for compliant issuers, meaning if you follow federal rules, you don't need 50 separate state licenses. Why does that matter? Because right now, operating a stablecoin or crypto business in the US requires navigating a regulatory maze. You need different licenses in different states. You face enforcement risk from multiple agencies. You can't get clear answers about what's allowed. A federal framework changes that, not necessarily in a way that makes everything easier, but in a way that makes things predictable. Companies know the rules. They can build compliance infrastructure. They can plan long-term. Investors and institutions can participate without fearing retroactive enforcement. This is why even crypto companies that don't love the bill's specifics still want it to pass. Predictability is valuable. Clarity, even if the rules are stricter than you'd like, is better than ambiguity where anyone can get sued anytime. But here's the tension. Federal clarity also means federal control. If the Clarity Act passes, stablecoin issuers are locked into whatever framework gets negotiated. They can't shop for friendlier state regulators. They can't operate in gray areas. The rules are set, and deviation means enforcement. So the question isn't just whether the bill is good or bad, it's whether the specific rules in the bill, especially on rewards, create conditions for growth or stagnation. And that depends on the details being negotiated right now. Let's talk about the second-order effects, the things that happen if the rewards question gets decided one way versus another, because this is where the incentive structures get really interesting. Scenario 1. Crypto companies win, and stablecoins can pay rewards. What happens? Money flows out of bank deposits into stablecoins. People and companies that were earning 0 or minimal interest in checking accounts move funds into stablecoins earning 3 or 4%. That flow is substantial. Even a small percentage of US deposits moving to stablecoins represents hundreds of billions or trillions over time. For banks, that's a problem. Deposits fund loans. Fewer deposits means less lending capacity. Banks would have to raise deposit rates to compete, which cuts into their profit margins. Or they shrink, which reduces credit availability in the economy. Neither outcome is catastrophic, but both are disruptive. For crypto companies, it's a massive growth opportunity. Stablecoins become not just a tool for crypto trading, but a mainstream savings vehicle. That drives adoption, increases revenue from reserves, and positions stablecoin issuers as central players in the financial system. For consumers, it's better yields and more options. If you can earn 3% on dollars just by holding stablecoins, that's an improvement over current bank account rates. There's risk, not FDIC insured, but for people comfortable with that trade-off, it's a win. Scenario 2. Banks win, and stablecoins cannot pay rewards. What happens? Stablecoins remain useful for payments and crypto trading, but they don't attract deposits away from banks. They're a medium of exchange, not a store of value with yield. Growth continues, but it's slower and more limited to crypto-native use cases. For banks, that preserves the status quo. They keep their deposit base. They maintain control over interest-bearing accounts. The competitive threat from crypto is contained. For crypto companies, it's a loss, but not a death blow. Stablecoins still have utility. Volume still generates revenue. But the big vision, stablecoins as the new form of money that everyone uses because it's better than bank accounts, that vision is capped. For consumers, it means less choice. You don't get the option of a high-yield stablecoin. You're stuck with traditional bank accounts unless you want to take on more risk in other crypto assets. Now, there's also a middle scenario, which is where the negotiation is probably heading. Stablecoins can pay rewards, but only under specific conditions. Maybe rewards are allowed, but capped. Maybe they're only allowed for stablecoins that meet certain reserve standards or operational requirements. Maybe they're structured as something other than direct interest, like loyalty program benefits or activity-based incentives. That middle scenario gives both sides something. Banks get protection from unlimited yield competition. Crypto companies get enough flexibility to offer attractive products. The result is a market where stablecoins can compete, but not completely dominate. Now let's talk about what's happening inside the crypto industry itself, because the external fight with banks isn't the only dynamic shaping this. There are internal tensions too. Coinbase, one of the biggest US crypto exchanges, stepped back from actively lobbying for the Clarity Act. Why? Reportedly because they didn't like some provisions or felt the bill didn't go far enough. That decision hurt the unified industry push. When one of the largest players pulls out, it weakens the collective negotiating position. This is a pattern in crypto, fragmented interests. Companies that should be aligned end up competing or undermining each other. It's part of why crypto struggles to get favorable regulation. The industry can't present a united front. There's also a shift in focus. The early crypto vision was about decentralization, DeFi, peer-to-peer finance, cutting out intermediaries. But the current regulatory fight is almost entirely about stablecoins and centralized issuers. DeFi barely gets mentioned in these negotiations. The conversation has narrowed to who gets to issue dollar-backed tokens and under what rules. That shift reflects where the power and money are. Stablecoins are a massive market. They're integrated with traditional finance. They're something regulators and banks care about. DeFi is harder to regulate, less institutionalized, and therefore gets less attention in these high-level negotiations. For people who got into crypto for the decentralization vision, this is disappointing. The fight that matters, the one that could shape policy for years, is about centralized stablecoins and whether they can pay yield. That's a long way from the original cypherpunk ideals. There's also retail fatigue. The crypto market has been volatile. Meme coins pump and dump, projects launch and collapse, scams proliferate. A lot of retail investors are exhausted. They're not paying attention to regulatory fights. They're either checking out entirely or chasing the next quick gain. This creates a weird dynamic where the most important policy developments are happening while much of the crypto community is distracted or disengaged. The rules being written right now will determine what's possible for years. But the conversation is dominated by insiders, lobbyists, and institutions, not the broader community. Let's bring this back to the core question. Who controls rewards controls adoption. That's the thesis. Let me explain why that's true and why it matters more than the specifics of any single bill. Right now, most people interact with dollars through banks. You get paid, money goes into your bank account. You spend, money comes out of your bank account. Banks are the interface between you and the dollar. They provide services, payments, loans, savings, and they extract value for doing so. If stablecoins can pay yield, they become a competitive alternative to bank accounts. Not a replacement, not immediately, but a real option, especially for people and companies that prioritize yield and don't need traditional banking services like loans. Over time, if adoption grows, stablecoins could become the primary way people hold dollars. Not physical cash, not bank deposits, stablecoins. That shift changes the entire financial system. Banks still exist, but their role changes. They're no longer the default custodians of dollar liquidity. They have to compete on services, not just on being the only option. Now, if banks prevent stablecoins from paying yield, they maintain that custodial role. Stablecoins remain niche tools for specific use cases, mostly within crypto markets. They don't become mainstream money. Banks stay central. So, the fight over rewards is really a fight over the future structure of finance. It's not about technology. Stablecoins work regardless of yield rules. It's about incentives. What do people choose to use? And the answer depends heavily on whether one option pays you and the other doesn't. This is why the negotiation is taking so long. Both sides understand what's at stake. It's not just about one bill or one policy. It's about who gets to be the intermediary for the digital dollar economy. That's worth fighting over. Here's where we land. The Clarity Act isn't stuck. It's negotiating the rules of the next financial system. The March 1st deadline was a coordination target, not a failure point. Negotiations continue. A committee markup is expected in March. Some version of compromise will likely emerge. That compromise will probably disappoint both sides. Banks won't get a complete ban on stablecoin rewards. Crypto companies won't get unlimited freedom to pay whatever yield they want. The result will be something in the middle. Rules that allow some rewards under some conditions, but preserve some competitive protection for banks. Is that the best outcome? Depends on what you value. If you want radical transformation and immediate competition, it's too conservative. If you want stability and gradual change, it's pragmatic. Most likely it's the only outcome that can pass, which makes it the relevant outcome regardless of whether it's optimal. What matters is understanding the incentives and power dynamics at play. This isn't a story about innovation versus regulation. It's not about crypto versus traditional finance. It's about who gets to set the terms for digital money and how much control they retain. Banks have systemic influence, regulatory relationships, and deposit bases to protect. Crypto companies have technology, user bases, and growth potential. The negotiation determines how those assets translate into power over the rules. And those rules, once set, are hard to change. Whatever framework emerges from this fight will shape decisions for years. Stablecoin issuers will build products around it. Banks will adapt strategies based on it. Consumers will make choices influenced by it. That's why this fight matters, even though it's technical and boring and gets almost no attention relative to price movements or hype cycles. This is infrastructure analysis, not investment advice. This is about understanding how systems get built, who has leverage in negotiations, and why single issues like stablecoin rewards can determine structural outcomes. Whether any of this affects short-term markets is unknowable and irrelevant to the core analysis. What matters is recognizing that financial systems don't just evolve naturally. They're negotiated, and right now, that negotiation is happening. If this reframed how you think about crypto regulation and what these policy fights actually mean, subscribe. We're here to explain power dynamics and incentive structures, not to predict outcomes or tell you what to do. Drop a comment if you're seeing connections you hadn't considered before. Let's talk about how financial systems actually get built when nobody's watching the technical details. Because the fight nobody's watching is the fight that decides everything. And understanding that is worth more than any prediction about when the bill passes or what happens next quarter.